Welcome everyone to our end of January edition of On Track for 2021. And I'll just point out all the performance numbers you'll see in here to the end of 2021. All the news and my conversations are right up to date for not the 67th of February, but the 27th of February. And let me just change that live while we're doing this. Fat finger syndrome. And so let's kick in. So this presentation is designed for clients of McGregor Wealth Management, particularly those that use our care methodology and care investment process. If you're not part of that audience, you're welcome to watch this, but please get advice before you act on anything that you may hear about in here. What I'm going to cover in today's session, we're going to have a look at some of the latest economic news, put it into context with where markets are at. We're going to talk about where each of the key markets that we invest in are up to and the returns. I'm going to talk about some of the popular topics of conversation going at the moment. What happens after JobKeeper, and what's this Bitcoin thing? Is it a bubble? I'm going to talk about the news cycle and the markets to put some of these things in perspective as well. So let me start off with sort of financial market news, and not much change when we look at the key interest rate numbers and exchange rate numbers on the right here. There's one big change. Government bonds, which were below 1% a few months ago, have jumped up to 1.7%. Still a low number. I'm going to talk more about that in a minute. What we're seeing in the news, vaccines are rolling out around the world. I'll go through some graphs on that in a minute. New COVID cases are declining rapidly. So when we're hearing about the mounting death tolls, the mounting cases, that's old news. What's more interesting is what's happening and what's the direction. And I'll show you some stats on that in a minute. The US earnings season, which is US company profit earnings season, which is now finished, was really good news. So companies are making good profits. The rebound in profitability was stronger than expected, and that's led to solid markets. We've seen good economic data in Australia and around the world, and that data is basically showing up lower unemployment than was expected in the height of COVID, and stronger growth, and all those things are good. And that's why markets have sort of risen. We are seeing the 10-year government bond rate starting to rise in Australia and in the US and other parts of the world. That's a sign that the bond market thinks that there's recovery on the way. So that's a sign that the bond market thinks there's potential inflation and growth on the horizon. It's still not a big, as I said, it's 1.73%. It's still historically low. But I'll show you a graph in a minute that shows how that's turned around. The Reserve Bank has continued with their message that interest rates are going to be lower for longer. They've talked about not putting up interest rates until inflation is over 2%. Now, when we say the Reserve Bank isn't going to put up interest rates, we're talking about the cash rate that the Reserve Bank controls. They don't control any of these other rates, the market does. So what we can sometimes see is market rates change before Reserve Bank rates change. So in this case, we're starting to see that with the 10-year government bond deal showing an uptick. So that's a good confidence sign. The Reserve Bank is though saying, as is the Federal Reserve and nearly all Federal Reserves around the world, that they're happy to leave rates lower for longer to make sure we come out of this with all cylinders firing, so to speak. And as well as low interest rates, they're also doing quantitative easing or QE. And that's where the Federal Reserve or the Reserve Bank uses their balance sheet to buy back bonds of the government. So the Australian Reserve Bank is doing that, where they're buying back bonds. They're doing that partly to control exchange rates. That's helping a little, but we've still seen our exchange rate rise up to about 80 cents as we speak at the moment. And at the height of COVID, that was down below 50 cents. So it's hard to keep a lid on the Aussie dollar at the moment. That's partly because the US dollar has been weak, but the Reserve Bank is trying to help that out by buying back bonds. A lot of people saying, "Oh, JobKeeper is going to finish at the end of March." There is a typo there. I'm not having a good day on the typos. So that finishes on the 28th of March. And what's that going to mean? Are we going to fall off a cliff? Now, the thing to note about all these things is the market has allowed for this. And I'm going to talk more about this specifically, particularly about how we react to news. And the big question for a lot of us who manage money is, how long does inflation stay low until those targets the Reserve Bank has got I touched on that briefly. But some graphs first. The graph on the top left here is the global daily new cases of COVID, and you can see it peaked back around December and it's dropping. So it's still high, there's no doubt it's high, but the direction is good. This is the daily new cases in the US. It's also dropping, despite sometimes the news making us feel like they're still out of control. They're actually back now to where they were in about October last year, and the direction is good. Daily new cases in the UK are dropping rapidly as well. And this chart on the bottom left is really interesting. So it shows the vaccination rate, the percentage of the population vaccinated. So Israel, who were the first cab off the rank, they're up well over 80, nearly 90% of their people now fully vaccinated. So we're going to start to see some interesting stats out of Israel, and they'll be the early example of what happens when we reach good vaccination levels. We've seen United Arab Emirates, and Israel's only a population of about 8 million. United Arab Emirates, a small population as well, but the UK is the most significant one here. So we see that up at about 25% and rising quickly. Boris Johnson's talking about the UK being close to fully vaccinated by the middle of the year. So Australia's going to get a very good insight into what that means. So we're going to see, hopefully, in the places where this is happening, cases drop off rapidly, and opening up internally, no lockdowns, no internal border closures, and hopefully opening up externally. But the external opening will depend on where the rest of the world is up to with vaccinations. So what we think will happen, no one knows for sure, and it seems the governments are still working out, but it's likely if you're going to go to a country, or if Australia's going to let someone in the country, they're probably going to have to show a vaccination certificate of some sort. And that will signal the beginning of getting back to some normalcy about travel and everything else. This is that 10-year government bond rate, and this chart shows the rate peaking back in the mid-80s and peaking at it's nearly 17%, by the way. So it's hard to believe you're getting paid 17% of it from the government to buy a bond for 10 years. One of the best investments of all time for anyone that was lucky enough to do that. We've then fallen all the way to nearly zero at the peak of COVID. But you can see in the last month, we've just ticked up. So we're now at that 1.73%. So that's a sign that the bond markets think things are getting better. It's also a sign that maybe inflation is on the horizon at some point, and maybe it's a sign that interest rate rises will eventually happen. It doesn't mean they're going to happen soon, but it's just returning to kind of a more normal level. So it's going to be interesting to watch that 10-year bond rate, which may be a lead indicator for a lot of other rates. So generally, there's a lot of good news on this page. Things are getting better. I'm going to talk about the news cycle in a minute, but just to the end of January 2020, the care portfolios are delivering as we would expect. It was a good 3 months. In 6 months, the 1 year is still showing COVID numbers in there. When I do the numbers to the end of March, so not next month, but the month after, we will have dropped off COVID. If you recall, the bottom of the share market was March 24th. So as we get into numbers from the start of April, returns are going to look spectacular. So there's going to be a contradiction there, because even if the markets go sideways from now, every time I speak to you in the next few months, we're going to see that 1 year return go up purely because of the statistics. We're dropping off bad months and adding less bad months. So watch that out when you're comparing investment returns. Be very careful about making sure you're comparing exact dates, because if people misquote those dates and they don't compare things, it's like comparing apples to oranges. So you want to make sure you get those right. But reasonably pleasing, the longer term returns for all of our portfolios are well in line with the targets we have for the plans that we use these for. The purpose of all the portfolios is simply to meet your long-term plans, do it in a way that works well. So our aim for these portfolios is the overall care management is that you experience over 3 to 5 years above average performance with below average fees, which is the case that we are delivering. So I'm going to put this in context. In the next slide, I'm going to talk about the news cycle. We have a framework that we use that describes where the market's at. So it's always very important to know where you're at any one time. Doesn't always tell you what's going to happen next, but it's a good starting point. So we rate the market as either being in one of 5 cases: boom or FOMO, bust or fear, and the wall of worry, where it may go between sort of cheap to fair to expensive. None of these things tell us what's likely to happen next, but they give us some guide, and particularly if we're worried about downside protection, as we do. We know most people make mistakes when they're worried that things get scary. So the biggest mistakes happen when markets are in boom or FOMO or in fear. People get excited, they put too much into the markets when they're going up, and then they panic and sell when it's down. And panic and selling is one of those only 3 ways to lose money. So very important for us to have this context on how we frame that. At the moment, we rate the markets at just a little bit above fair value. That's not done with a high confidence level, because if interest rates stay low for longer, then stock markets, share markets are probably particularly cheap. But if interest rates go up as we expect them, then we think markets are kind of about fair value, just a little bit fair value. Just a reminder, you've all survived the 5th worst downturn in the share market's history, or recent history, going back to 1900, and that's a good thing. We've seen markets come back. This chart's a month old, but it shows the market coming back. But the point I want to get you ready for the next slide is around this cycle of psychology. The market swings through cycles. Sometimes it's neutral. We're kind of in a neutral space at the moment, but the extreme cycles where we swing towards FOMO. And FOMO is the fear of missing out. And I'll talk about a market that's in that cycle at the moment. And it's the fear that your neighbour or your friends make more money than you. So all of a sudden they're getting 50% return on their investments and you're only getting 25. So you charge into whatever it is that's causing those high returns. I believe more mistakes are made during those FOMO cycles. They're pretty rare, thankfully. We only get them about 15 to 20 years in the share market, where markets do go really crazy. And FOMO is not the same as just an expensive market. So yeah, when we start talking about FOMO, it'll be red alert. That won't mean you get out of the markets, by the way, but it'll mean we'll be very careful about making sure we've got plenty in reserves and some of the other strategies we use at those times. At the opposite end is the fear. We saw that, as I talked about at the bottom of COVID. And look at the volume. So the green and red bars down the bottom here is the volume of shares traded. So the volume went up on that fear. So there was a lot of people selling at that time, and that's that panic. Why would they sell at that time? Quite simply because they thought it was going to get worse. They thought that's when the news was the most bad, and that's when they thought, wow, this is going to lead to a terrible economy, that's going to lead to low profits, I better get out of the share market. But the share market factors these things in. That's why it dropped. It already knew the market that the economy was going to be bad. It was anticipating that. And that leads me to a cycle on the next page. But I do want to talk about this, some examples of FOMO before. I'm going to bring in the Bitcoin conversation. So I'm not going to give any extreme opinions on Bitcoin, except to say it's quite clearly in a pattern that looks like a bubble. So it's quite likely this may mean a bubble. Where Bitcoin ends up is anyone's example. I don't invest in it, and I actually want to clarify investing versus speculation. Investing to me is where we buy assets at reasonable value that produce income. So speculation is where we buy assets that don't produce any income on the hope that the price goes up. So Bitcoin doesn't produce any income. There's derivatives of Bitcoin that do produce income, but that's another story. But so in itself, and speculative assets include things like currencies, gold, precious metals, precious gemstones, artworks, these types of things. So they don't produce income, but we hope they go up in value. So our focus for you and your portfolios is 100% investment. Now, this isn't a black or white thing. You can have speculative investments, and we've seen that in the share market. So the top right here is the NASDAQ market during the tech boom around the turn of the century, 1995 to 2003. And if you go to the chart on the left here, you'll see that markets take off, and then eventually they go through this crazy period of greed and FOMO and delusion, and the markets look like they go straight up. So the tech boom did that, around about 2001, where markets went up massively. And when you look at the scale, they go up 3 to 5 times during that So it's quite unsustainable, what eventually happened. So even though the logic behind that, technology and the internet, this was when the internet was becoming mainstream. This is when we knew the internet was going to change the world. So that logic was right. But what happens is people paid too much for the companies that made that up, and eventually they come crashing back down to earth. Now, the internet's still here. It's embedded in all sorts of corporates. So the story wasn't right, but the price people paid for the asset was wrong. It just got too high. So back we came down to earth over that period of time. Bitcoin looks like it's going through a similar episode. I don't know if we'll all one day spend Bitcoins like we spend our dollars. I'll leave that to other experts. There's some stuff online for anyone that's really interested in understanding different views on that. Please email me. I can send you a few articles from people I trust to read on that. But make no mistake, it's a highly speculative asset, quite dangerous at the moment. One for only traders who are trading money they can afford to lose the lot. There's a fair chance Bitcoin comes all the way back. We've started to see it in the last few days. And anyone in those markets may want to take some profits. And as I said, I'm not going to speculate about where that finishes, but I'd be very, very, very careful, and you only be putting money in there that you can afford to lose the whole lot of, and certainly avoid any sort of gearing or borrowing in that market. Some other examples of bubbles, past bubbles. The Japanese commercial property market in the 80s went straight up, and then it's been going down sort of ever since. And ironically, values, and this was an article from sort of 2013. At that stage, prices were where they were back in the 80s. So the challenge when you have a bubble is it takes a long time to recover. The Dow Jones Index, industrial average, back in the roaring 20s, went up exactly the same way, then came crashing down over time. And obviously, it's since resumed its normal pattern. We've had, nearly 100 years of good growth from there. But for the period after a speculative boom or FOMO, it's very dangerous. So that's my take on Bitcoin. Share markets are nowhere near that sort of level at the moment. Share markets are just in what we call a fair value. But we do aim to try and have an opinion on when and if they ever get to FOMO, but we're a long way from that at the moment. As you know, I'm not going to dwell on this, the 4 pillars of the care investment process. Learning from history, a lot of what to talk about is understanding those cycles. Personal planning, all your portfolio is designed to deliver your plan. Understanding behaviour, the fact that we do make bad decisions, particularly at crazy times, and trying to avoid that. Then we can do it properly, which is what we do with the care processes. Good asset allocation, massive diversification, regular rebalancing. I'm going to show you some of that diversification here today by lifting the lid under some of the portfolios and talk about some of the recent rebalancing. But I want to talk about the news cycle, and I'm going to use JobKeeper as an example here. So I've come up with a framework. I like developing frameworks to help people understand complex things. Excuse my graphics, I'm very good at investment markets and frameworks, not so good at graphics, but you kind of get the picture. So when we get news, it's either good news or bad news, and it can be on the scale here, very good news to very bad news. And when we get news, it can either be a complete surprise or it can be completely expected. Let me give you an example. So when COVID started, that was bad news, very bad news. That was a big surprise. So we expect markets will go down when we've got that combination of things. As markets bottomed, we started to get news that was sort of less bad. And let me use some bad grammar here just to emphasize the point. So on the right-hand side of the scale here, good news is good. But once the good news is in the market, it has to be more good. And yes, I do know that's bad grammar, but I like it to emphasize the point here. It has to be more good to push the markets up, or it has to be less bad. So the reason we saw the markets turn around on March 24th is because the news became less bad. So less bad news that's a surprise actually makes market go up. This is the one that confuses a lot of people because they say that's still bad news. Look at all these people dying. Look at all the cases of rising COVID. Yeah, but we knew it was, but it's now less bad because in that case, we now know that governments are going to spend a lot of money. We know that reserve banks are going to prop up the economy. So the news becomes less bad and markets go up. So then we get news like JobKeeper is going to finish at the end of March. Now, this is completely expected. We've known about this for literally 6 months. So the market takes that into account. So the news of that happening and the eventuality of that happening won't change the market much. Now, the market already has, let me get up some things here. So the psychology around this is the more extreme we were at one end, the more this will impact as well. So if we're in a FOMO market where the market's gone through a boom and we get less good news, because on the flip side, bad news obviously makes the market go down if it's unexpected. Increasingly bad news makes the market go down more if it's unexpected, but less good news can also make the market go down. So we might be in a boom where the economy's been growing at 6-7%. If all of a sudden that growth slows down, that news is less good, and less good is bad. Apologies for the grammar and the puns, but yeah, so less good is bad, and that means markets start to fall. So those bubbles I went through before, they eventually start to go down when the news becomes less good in those areas, and they capitulate when the news starts to become bad. And that the biggest downturns happen when the pendulum had swung all the way to FOMO. Conversely, at the other end, if the pendulum swung all the way to fear, and we start to get news which is less bad, then we start to see markets go up. This is what happened on March the 24th last year, where the news was still bad, but it became less bad, and we were at fear. So we saw markets at fear levels, so that meant less bad, plus surprisingly less bad news, markets go up. So I don't expect the end of JobKeeper to change the market's view. What may happen is, and let me add another point to the conversations here, but in the market price is embedded all current facts and opinions. They're all built in. So it takes, to beat the market, you need to have new news that no one else has, or unknown facts that no one else has, or have a better opinion, all of which are very hard to do, and very few people can do that consistently. We don't aim to have a better opinion than anyone. We aim to have all the facts that we can. We aim to be able to put in a framework. We aim to not panic like some do at different extremes. And we aim to have an opinion on where the market's at that's based on some reasonable grounds. So that's what we're trying to do, particularly around if markets get into a boom or FOMO stage. But in terms of that, back to JobKeeper, JobKeeper's, the facts are known about that. What's unknown is how bad an impact or good an impact it will make on the economy. So if the end of JobKeeper starts to see bad economic news that's unexpected, yes, you could see markets go down. But if it sees less bad news than people expect, markets will actually go up. And this is the hard one for people to realise. So both the last two US presidential elections, Trump getting in and Trump getting out, have seen markets bounce strongly after the result was known, because we now knew the result. We knew even if we thought things were going to be bad, they were going to be less bad. So that's good news for the market, and up it goes. And I know this is a little bit who's on first type of stuff, but it's a simple framework that allows you to say, when you hear some news, say, is this new news to the market? If it is new news to the market, is it good news, bad news? Is it worse, more bad than we've been getting, or is it less bad? So the announcements, when you think about those COVID charts I showed up before, 250,000 new cases around the world, that's bad news, but it's less bad than it was 3 months ago when there was 500,000 cases a day. So that less bad news is good for the market, because the market's looking ahead all the time. So I hope that's a framework you can use. You've heard me talk about these things before, but I thought I'd put it in a bit of a framework chart that we can use to discuss news as we go forward. All of this, the mess it up, I'm not going to focus on any of these areas today, except these are all the ways people mess it up. And they mess it up in a way that sees most investors achieve half the returns that their investments get because of the bad behaviour, the bad decisions they make caused by all these issues. And we've just been through the biggest single issue obsession that I've ever seen in a lifetime, COVID. There'll be a point somewhere in the next few years where we just don't talk about it much. That's the point where markets and life will be kind of back to normal. So let's have a look at the numbers, and I've added in some extra data this month. I'll talk through that. So Aussie share market up 0.32% for the month. And you'll see what I mean about performance here. So we're starting to see, as I record this on the 27th of February, you can see in the next month, a year ago, we had that precipitous drop in markets. So if I'm recording this on the 28th of March next month, there'll be no downturn. So we're looking at that from the bottom back to where we are now. It's going to show up at about a 30% return. Now, even if the market goes sideways, all of a sudden 1 year returns are going to say 30%. Now, some people will manipulate that news and say, wow, shares are up 30%. Last month, they were only up. The 1 year return at the moment is actually minus 2%. So they'll make it sound like that all happened in a month. And it didn't happen in a month. We just dropped off one bad month and added on one good month. So very important, as I said before, to compare apples to apples. What I've shown down here, as well as the long-term returns, which are highly stable, is the top 10 that make up the Aussie share market, and particularly VAS, the company that the exchange traded fund we invest in, which is quite interesting. So Commonwealth Bank, BHP, no surprises. If you look at the top 20 at the moment, it shows Afterpay has snuck in the top 20. What's interesting here is when we look at the 1 year return. And this is why diversification is so important. So BHP's had a fantastic year, as has Wesfarmers and Rio Tinto. CSL, not so good, which is ironic. CSL is actually in the vaccine market. But CSL it's had a bit of a headwind in that the Aussie dollar has climbed. So at the bottom of April, the Aussie dollar was actually about just under 50 cents. It's now up to 80 cents. So that means CSL, which does all its sales in US dollars, it looks like it's done worse, even though it hasn't done worse. So yeah, markets are complicated. That's why diversification and professional portfolios is so important. So we go to the US share market, same similar story. The US market in Australian dollar terms has been well over its previous peak back since about September. That's partly because our view of it is the Aussie dollar. So international shares, as the dollar went up, that has been a bit of a headway. So have a look at the top 10 companies here. So you'll see Apple at the top, 5% of the US share market, or VTS, which is the company that we invest in the core portfolios. But have a look at the variety of returns here. So you've got Tesla, which is now snuck itself in between those FANGs. You've heard me talk about the FANGs. It's Facebook, Amazon, Microsoft, Apple, and Google, or Alphabet. All of a sudden, Tesla's now in with those FANGs. It's gone up 344%. It was fascinating that Elon Musk invested $1.5 billion of Tesla's cash reserves in Bitcoin. And Bitcoin's actually dropped since then, so I'll be interested to see how he looks on that. For everyone that loves Tesla as a climate changer for the batteries, there's also some slight irony in that Bitcoin mining chews up a lot of electricity, which at the moment comes from coal fire. So a lot of contradictions in the world at the moment. But the top 10 here have grown a lot. So that, and you'll see that in high PE ratios. So, but equally, there'll be a bottom bunch here that haven't grown as much in the US, and the US is quite a diverse market. But the 1 year return here, positive, 5.26%. Next month, that's going to look spectacular. It's going to look like about 30% the 1 year return. By the time we start to look at from the end of March, it's going to look like the 30% return. It won't be real, but the market is up literally kind of 30% from the bottom. So that's what it's going to start to reflect. US small caps, another good year. So US small caps are actually up 7%. They've had a really good year. They were coming back from a big low. And you'll see, have a look at some of the returns at the top end of here. There's a company here called GameStop. That was the one that all the shenanigans was about in the States, up 2,300%. Absolutely massive. So whenever you see the headlines about a company like Tesla or about a company like GameStop going, know that you'll own a little bit of that through these things. So through IJR, you'll effectively own 0.5% of IJR, so not too much. So you've got a little, none that's ever going to break the bank, but you do own these companies as they march through the index. So small caps are a great return. We actually sold a little bit of small caps at the end of the month to take some profits out of the market. I'll show you that trade. Global leaders, this is the top 100 companies in the world. So you see some of the same companies as before, Apple, Microsoft, etc. But others like Procter & Gamble, Nestle, Intel, Johnson & Johnson, JP Morgan as well. So once again, pointing out the massive diversification. And Apple's probably a stock that's started to creep up in the weightings. So it'll be one we'll watch with interest to work out whether whether we're ever going to have too much Apple. But to put it in perspective, in your portfolios, you'd own less of Apple than you would of Commonwealth Bank, the top company in Australia. Whereas Apple's a $1 trillion company these days, and Commonwealth Bank, while being a multi-billion dollar company, not so big, good returns on those stocks as well. And emerging markets, so has also had a spectacular year. The COVID blip, which is on the bottom in this one, so I put the charts upside down here. We're well and truly past COVID in a way. And this is because emerging markets have recovered quickly. They'd also suffered in the 2 years leading up to COVID with the trade war, the US-China trade war. So we've seen that come out well. And you'll see some other interesting stocks in here like Samsung, Taiwan Semiconductor, Tencent, Alibaba. So you get some big companies in here as well as lots of smaller companies from all around the world in those emerging markets, China, South Korea, etc. So Samsung obviously being a Korean company, which is how it fits in there. And long-term returns from here. 3 years, if you look at emerging markets, sometimes you'll say, wow, emerging markets has had a good run. Should you be getting out of them or something? Emerging markets over the last 3 years was bad. It's only averaged a 5% return. And this is where that importance of diversification and rebalancing becomes so critical. Gold, what your portfolio is there is just pure gold bullion. So in gold, the gold exchange traded fund that you own through that effectively just owns a whole bunch of gold bullion. Why do we have gold in the portfolio? It's there as insurance. Gold tends to spike when things go bad. So when we look at COVID last year, gold price went up. And if you look at the chart over the last few years, gold went up as people started to worry about the US dollar and trade wars and other bits of uncertainty. So it adds that sort of insurance. It adds a currency hedge against particularly the US dollar, potentially an inflation hedge, and it also adds diversification and rebalancing. And I'll show you an example of that right here. So we did a rebalance at our last investment committee last week, where we effectively sold some of IJR and bought some gold. So have a look at this. The top left chart here shows the chart of IJR, which is US small caps, and it had a good 3 months. This is a 3 months chart. Gold had a not so good 3 months. So we take a bit of profits from this and we buy a bit back there. Now, as these things converge, as they often do over time, so on the top right, you'll see there's the same two ETFs, but over the last 3 years, they're pretty close to get their performance. But a massive gap in this last year. And we've rebalanced twice, at least twice during this. So that means we've benefited from that. We know that rebalancing adds 0.5 to 1% of the portfolio. And you can see that in the active portfolio, where we've got diverse things like gold. The active portfolio in the last year has been 5%. The last 5 years, 11.8%. So it's delivered extremely good long-term returns. And part of that benefit has just been the discipline of regular rebalancing. And I show here the returns of each of those, 1, 3, 5, 10. Just so you can see, at any one point in time, so if you look at the last month, we had small caps go up 6%, gold go down 0.7, ASX 200. So these things create rebalancing opportunities for us. This is the easiest way to make superior returns without taking risk. So it's the discipline of that modern portfolio theory that we talk about. Property, and property is going through some interesting times. These are the averages of the big cities, and this doesn't show outside of capital cities. We've seen we've seen big increases. I want to be careful on my words. Big increases in areas outside. So if you look at month-end values here, you can see that month-end value, so change month on month, we've seen some good numbers. So Darwin up, Brisbane up 1%, Perth up 1%. The change year on year is starting to now get up to be significant. Darwin, which had been on its knees literally for the last 5 years, is up 10%. Good news for our clients who've got property in Darwin. I know there's a couple of you. And Perth starting to rise again. Brisbane rising, but and Hobart still strongly. The story is really in the regions, and I don't have any data to present. I'll see if I can get some for the next on track. But the Sunshine Coast, for instance, is up 15% over the last 12 months. And there's areas of some areas of the Sunshine Coast are up 20 to 30%, because in the COVID world, post-COVID world that we're doing, people want a getaway place. So people are buying property unseen in areas like the Sunshine Coast, like Noosa, but also in areas like Port Macquarie and even country areas, rural areas have seen great increases in the last few months. So that's fascinating. Our friends at Harrington White now have most of Australia in the rising market section. So this is a matter of fact, all these markets are rising. And you'll see some of those regional areas, Southern Highlands, Toowoomba, Rockhampton, Port Hedland, all the areas that have been held down for a while, Gladstone, Emerald, Coffs Harbour. So all these areas are on the march. It does include Melbourne and Sydney at the start of their recovery. They've still got areas like Sunshine Coast at the peak of that market. Maybe it is, maybe it isn't. It's very hard to tell. Some of these markets like the Sunshine Coast and even Geelong may be in the process of being re-rated to be more similar to Melbourne and Sydney prices. So there's some people that may argue that long term areas like the Sunshine Coast will be just as expensive as Melbourne and Sydney. At the moment, the median value of the Sunshine Coast is about 70% of the value of Melbourne and Sydney. So if we eventually match that, that would mean there's still room in this cycle. But you want to be very careful buying into markets that have risen a lot. You want to make sure you've got a long-term time frame, or you've done your own analysis on where you think the markets are going. Now, obviously buying for houses to live in or selling your house to buy another house, and just doesn't matter where the market's at for that, except for tax reasons. In other words, if you're moving from one street in your neighbourhood to another street, whether the price is up or down, it makes no difference to your long-term well-being, just what tax is realised. So yeah, interesting case. The unit market shows much the same, but start of recovery for a few more. Still got bottom of the market, Perth and Sydney, we're seeing Melbourne. So we're seeing inner city apartments in those areas still on the nose a little bit, though obviously people didn't enjoy being locked down in small apartments in the big capital cities. Obviously, they'll eventually start their recovery as well. But yeah, if you're looking for advice on property investing, please yell out to one of us, and we can give you some hopefully wise words there and point you towards people who help us make decisions on property there. So that's to the end of this month's meeting. I just want to reinforce, as always, that process. But all our portfolios are based on your plans, and all investing is best done as part of a real financial plan. That plan has goals that are based on what's important for you, and the portfolios are designed to meet those goals. We take a long-term view, but we take a short-term interest in things. We make sure we have massive diversification. You've seen some of that today. Just the right asset allocation for you and enough liquidity to get through a crisis. We do use low-cost indexing for most growth markets. That's put us in that above average performance category. It's interesting that most of the leaders over 5 years in the performance tables, which includes us, are predominantly index based. And that's because of the low cost and the certainty of actually capturing the market movements. We do protect against short-term volatility by holding enough reserves for our retired clients and by dollar cost averaging for our clients that are building wealth. We do protect by rebalancing regularly as well. And just remember, there's only 3 ways to lose money. Don't do them. Panicking and selling, having to sell, and not properly diversify. So, nearly a year from the bottom of COVID. So, congratulations to all our clients who we haven't had one person panic and sell in that time. We haven't had anyone who had to sell in that time. We actually had people that were very proactive during that time with their dollar cost averaging or topping up their markets. But just having held on means you go on to win. Always good to talk. Look forward to talking to you in the next few months. It's going to be fascinating to watch the statistics over the next little while, both around the markets, around COVID, but watch out for quotes of returns. In the next few months, we're going to see 10 to 30% returns quoted for funds. And while that's going to be good, it's really reflecting the quick recovery from COVID. Have a great month. Look forward to talking to you next month. Rob McGregor signing out.